Hello and welcome to this video, which is about NISM-Series-V-A Mutual Fund Distributor Certification Exam. In this video, I will take you through Chapter 1 of the book. The Chapter 1 is about investment landscape, and in this video, I will take you through 30 multiple choice questions, okay, which will help you to prepare for the exam. In case you need personal guidance, you can get in touch with me. Of course, personal guidance is at a nominal cost, uh, which is affordable. So you can take that guidance in one-to-one meeting with me. But that is something which is not for everyone. Let me first go through this video and take you through the questions. Quiz 1 is which is the first step in the process of financial goal setting? So, goal setting is very important in our financial journey, and we need to set the goals very correctly. So what should we do if we want to set up the goal? There are four options. Select an asset class. Obviously, that cannot be the first step. Estimate the investment returns. Definitely not. Hire a financial advisor. A good thing, but not the first step. What is the first step? Identifying life events requiring money. So C is the option. That is right here. This is quiz 1. Quiz 2 is which of the following best describes critical responsibility goals? So each goal is not bucketed as same. Some goals are under critical responsibility. So buying a vacation home obviously cannot be critical responsibility. Purchasing a luxury car cannot be also that. Traveling abroad for leisure, well, definitely not. Child's higher education, yes. So C is the answer again. Which of the following is the most suitable to meet a long-term financial goal? You're looking at a 10, 15, 20-year horizon. Uh, so savings account, fixed deposit and recurring deposits are of limited help. Savings account in fact is of really no help, but fixed deposit and recurring deposits are of very limited help. So you will have to rely on diversified equity mutual funds. So the answer is C. Inflation has the greatest impact on which type of goals? Daily budgeting, well, not much. Month end expenses, yes, some impact is there. Short term emergency funds, not much of an impact, but long term retirement planning, yes, significant impact. So the answer is B. An asset allocation that changes based on market conditions is called as tactical asset allocation. Okay, because of the change in the market condition, we have to change the allocation, and that's called as tactical. It's not risk profiling, it's not goal based investing, and it is not strategic also. Okay. Behavioral finance suggests that investors often make poor choices because of which reason? Is it because of higher returns or high returns, regulatory pressures, lack of bank support? No. This we are talking about behavioral finance. Behavioral finance studies the behavior or the way investors make choices and all that. So the answer is emotions and cognitive biases. We are driven by biases. We may have multiple biases, like for example, what's called as the recency bias or overconfidence bias, right? So the answer is C. Which of the following is a feature of equity investment? Well, when you buy equity shares or shares of a company, guaranteed return is never given. Volatility is very high, and fixed income you never get because equity returns are variable. But ownership in the company, yes, that is possible. So answer is C. Which asset class is considered to be most liquid, or rather most illiquid, right? Not liquid, illiquid. Equity, commodity, real estate, mutual fund. By miles, real estate. So the answer is C. What does confirmation bias refer to? Making decisions based on complete analysis? No. Avoiding unfamiliar assets? Definitely no. Ignoring all external advice? No. Seeking information that supports pre-existing belief? Yes. So confirmation biases, we are trying to work as if whatever we believe is right. So you support it with lot of information, and that becomes confirmation bias. The objective of diversification is to maximize taxation. Never. Concentrate risk. Well, never. Diversification, in fact, means do not put all your eggs in one basket. Spread and reduce unsystematic risk. Yes. You have two types of risk, systematic and unsystematic. Diversification helps us to reduce the unsystematic risk. Systematic risk stage. So eliminate all market risk is not possible through diversification. Diversification can only take care of your unsystematic risk. So answer is D. Which of the following best describes liquidity? Okay, liquidity is neither safety of capital nor regulatory compliance nor ability to earn fixed returns. It is ease of converting investments to cash. How fast can we convert an asset into cash without cost, significant cost, is your liquidity. So the answer here, let me tell you, was B. Real estate may not be suitable for short-term goals. You should never invest in real estate for short-term goals because it lacks short-term liquidity. It takes very long time to sell real estate. It generates higher income. It easily divisible. It's tax-free. They're all not making sense. Answer is C. What is the purpose of risk profiling? When you profile a customer or rather your client or an investor based on risk, what do you look at? Do you identify tax saving instruments? No. To determine KYC eligibility? No. Do you classify mutual fund schemes? No. Understand the investor's ability and willingness to take risk. That is what is risk profiling. So the answer again is C. Most of the answers actually are C. Okay. Which of the following is an example of strategic asset allocation? Moving between equity and debt every quarter? No, 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 no. Strategic asset allocation is not that. Following herd mentality? Well, that's a behavioral aspect. Investing only in trending sectors? No. Maintaining 60% equity, 40% debt on goal based analysis or goal analysis is correct. So the answer again is C. Herd mentality bias is following the crowd. You are part of a herd, walking in like a herd. So ignoring market news, investing contrary to public opinion, consulting financial advisors are not herd mentality. Following crowd behavior without analysis is herd mentality. Just because everybody is doing something, I will also do it. An investor who believes recent performance will continue indefinitely is suffering from recency bias. Very easy, because you are influenced by recent events. So the answer is C. Familiarity bias will not come, loss aversion will not come, and overconfidence is also not applicable in this case. A key drawback of physical gold as an investment is that there is no regular income. So if you have physical gold, you may expect higher returns. You may easily value it based on market price. Government regulations are same. So the answer is no regular income. What is the primary aim of setting financial goal? Optimizing taxes? No. Ensuring guaranteed return? No. Planning future expenses with timelines and values? Yes. Tracking past investment is also not part of this. Why is self-occupied property not typically considered an investment? Because selling self-occupied property affects lifestyle, right? This is not an investment, right? It earns rental income. No, it is tax exempt. No, it is a financial asset. No, it's a physical asset. Real estate is not a financial asset. Please remember that. If you get any question, you need to be clear. However, the answer here is C. Tactical asset allocation is most suitable for inexperienced investors? No. Investors with fixed income? No. Seasoned investor with surplus fund? Yes. PPF investors not applicable. So answer is C again. Risk of loss due to borrower's default is very simple. It is called as the credit risk. Market risk is because of fluctuation in the market price, the risks that you face. Liquidity risk is when you are not able to sell an asset to convert it into cash. Interest rate risk arises because of fluctuation in the interest rates. The concept of real rate of return means returns adjusted for inflation. We have two returns, nominal and real. Nominal minus inflation gives us the real return. So the answer is simple, inflation. Okay. Strategic asset allocation aims to, beat inflation. No. Uh, Time the market. No. Avoid volatility. No. Well, beating inflation can be an objective of investment, but not essentially a key objective of strategic asset allocation. Maintain a disciplined approach aligned with goals. Yes, that is what we will call as the strategic asset allocation. Mutual fund distributors are expected to recommend high risk products to all. No. Push products based on commission. No. Recommend suitable scheme based on client profile. Yes. Operate without SEBI regulation. No way. Risk of not being able to sell an asset quickly, we have already discussed. It is liquidity risk. You cannot sell an asset quickly, not because of inflation, credit risk, or overconfidence risk. It is liquidity risk. Huh? Question number 25. 26. What makes bonds safer than equity in general? Dividends? No. Dividends are given on equity shares. Ownership? No. Fixed prepayment terms? Yes. Price fluctuation? No. So the answer is C. Equity investing is suitable for very short term needs? No. Regular income? Not really. Long term wealth creation? Yes. Tax refunds? No. So the answer is C. If an investor invests only in company stock they work for, the risk is well diversified? No. Concentrated and sector specific? Yes. Ignored? No. Fixed income backed? No. So the answer is B. Investors should avoid which of the following practices? Diversification, risk profiling, goal setting. They just cannot avoid. Following crowd without analysis is something they must avoid. Right? Question number 30. In a mutual fund structure, professional help is provided by investors? No. Bank branch managers? No. Rating agencies? No. Asset management companies? Yes. So, thank you. These 30 questions have been created to help you prepare for this exam with the latest updated workbook. Please do share your feedback. Thank you.